Welcome to the WealthGenius Podcast, brought to you by the Expand Wealth Real Estate Fund. Expand your wealth by investing in apartment buildings. Go to expandwealthfund.com to book your info session. The WealthGenius Podcast, strategies for multifamily real estate investing, mindset, community, success. The WealthGenius Podcast with your host, the godfather of real estate, Alfonso Cuadra, who has expansive experience in business and massive success as a real estate investor. The WealthGenius Podcast. Let's dive into today's episode.
Let's go, Austin. For the first time, we get to meet. Incredible.
Yeah, it's been a few years that we've been working with WealthGenius and the Expand conference. So even myself, I wanted to get over here, get involved, and see what you guys are doing, because you're definitely making a name in the space, and I want to find out what you guys are doing so well so that I can find out and take some of those trade secrets for myself too.
I love that. I love that so much. You know, I saw what Equiton has been doing, and I remember even before the pandemic, I would say, maybe correct me if I'm wrong, 2015, 2016?
Yeah, it's perfect. Yeah, founded 2015, started raising capital 2016.
Yeah. And so when I was introduced to Equiton, I think you guys were maybe around 500 doors, and I can't remember the size of the portfolio.
Yeah, of course.
But you guys are $1 billion plus.
Yeah.
Yeah. And I don't know how many doors under the portfolio right now. Where are you at right now?
Yeah, so as of today, on the apartment side of it, which is where we would track more so the doors component, we're just under 3,500 individual units.
Wow.
So yeah, definitely a bit of growth since we originally started working with you guys a few years back.
And so how have you been able to maintain? Because you've gone through ups and downs, interest rate hikes, COVIDs, all that stuff. Yeah. But you guys have kind of maintained steady Eddie, and you've been able to grow with the market. I think when I first got introduced to Equiton, I think you guys were focused primarily in Ontario. Mm-hmm. I'm not sure if that's changed. Maybe you can correct me. But so what's kind of like the sauce, or what is it that what is the draw to Equiton, and why did you guys continue to grow?
Yeah, I mean, I think there's several reasons, and it's interesting that you point out some of those market events that have happened over the previous years, things like COVID, things like 2022, where the financial markets were in a bit of turmoil, even 2023, 2024, rough markets for real estate as a whole, right? Mm-hmm. And, I think to tell you that answer, I'll have to give you a bit of my background so you understand where my vision comes from in answering this question. I actually started with Equiton in 2019. So prior to joining Equiton, I was a financial advisor, and I was working with one of the big 5 banks. I quickly realized after working at one of the banks that I just didn't love talking about mutual funds.
Not that exciting.
It wasn't something that got me invigorated on a daily basis. So I started looking for something that would be a little bit more close to my passion. And that led me towards real estate. And I say real estate because I was very, very fortunate to grow up in a household where my mother was a real estate agent. My dad was a mortgage broker. So growing up, I got very in tune with buying, selling properties, the financials that go behind them. And it was always a passion of mine. But I didn't really know that there was investment options out there that you could passively participate in real estate without having to manage properties or be the one buying or putting your name on title.
Yeah.
When I found out about this, I was quick to make a jump, and I actually wanted to start with a smaller company that I could help build with, and that's exactly what I did. I found Equiton back in 2019, and 6 months later, COVID happens. And you're at the company, and you're thinking to yourself, well, what is this going to do, right? How is this going to impact the firm? What does that mean for the opportunities? Are people still going to want to be investing into this category? And they did. And I think the biggest components that we did really, really well as a company was that there's a very stark focus on a conservative approach. As a company, we talk about targeted returns. As a company, we go out and we have to buy properties, and we have to put our brand on it, and so we need to know exactly what this is going to generate for investors and what can we do to control the growth of these projects going forward, whether that's development projects like condos and townhomes or apartment buildings that you need to buy and run effectively. I've been so fortunate, again, to be able to work at a company with Jason Roque, who's our CEO, and Helen Hurlbutt, who's our CFO. phenomenal individuals. They have done an absolutely phenomenal job of operating the company from a very conservative perspective. They do a great job when they're building out financial statements and pro formas to know exactly what to expect from properties when they purchase them. When we go into development opportunities, they do a great job of finding good locations, really understanding the marketplace, and not jumping at the first opportunity that pops up, but rather booting out the ones that don't make sense and really hopping on and being aggressive with the ones that do work for us. And I think that that's just been relayed to investors in both the trend that we've had over the years. It has been really great from a transparency standpoint. We do a good job of being able to offer up all the information from the firm so that it's visible to investors to know what properties we're buying, how big are they, what do we purchase them for, what are they valued at today, what's the location of them. Allowing that level of transparency in an otherwise passive investment solution, it's not common. You don't find that all the time. And so I think that even when we got into periods like COVID, when we were, myself only a couple months into the company, we did a great job because we had a solid track record. We still maintained positive performance. There was something for investors to go invest into tangibly that was, more like physical real estate as opposed to, stocks that were all over the place in 2020. They were up, down, left, sideways, and you didn't really know what was going to happen. And a lot of that was the best things that happened to us. COVID was a huge impact for getting people to look for alternatives. They said, well, if I'm getting all this volatility in the public marketplace, where can I go that I'm going to find maybe more stable returns or something that I know what to expect from the investment? And that was huge for us. And because we had transparency, we had a good track record, and we had a good conservative approach, we've been very lucky to find success throughout the years. And you're not wrong. When I joined, the company was about $95 million in assets under management. That was the total amount of portfolios that we owned. And I'm happy to say that today we're now well over $1.2 billion.
Woo! Let's go.
So it's been an exceptional growth story.
Yeah.
And we just continue to look for new opportunities to keep progressing that further.
So there's this trend. I saw this graph where you see where the high net worth individuals, where the money's moving, and it's all moving into private REITs. Why do you think that all these high net worth individuals are doing this?
So there's an interesting chart that you can have a look at, actually, and it's called the Canadian Private Apartment Index. The list is distributed by MSCI, I believe. And the reason that I find that useful is because it's not an Equiton tool. It's a general index tracking the marketplace in Canada for private apartment investments. And if you were to look at that index, it is an amazing story. Because when you look at 35 years of performance, 35 plus years of performance in that category, it's never had a negative return, negative annual return, ever in that 35 years. That's consistency. When you talk to any investor who's looking to park their money away and make a good return, one of the first things you think about is downside risk. And I think when you kind of, portray that notion of high net worth investors, I even take that a step further and say things like pension plans. If you look at the top 7 pension plans in Canada, maybe not private REIT specific, but alternative investments or private investments, the allocations to this sector are on an upward trend. And if you look at the allocation changes, you can see in some instances back in the mid-90s, their allocations might have been sub 10%. Today, 40+%. There's a balance that they're finding here, and it's that private investments, the value of the investment is tied to the appraisal value of the properties. So in an example like that, regardless of what's happening in the public market space and stock market, every day there could be a political event or a economic crisis that's impacting the public markets, and some days up, some days down. That's the whipsaw that you get with being on the public side. But on the private convention, you don't have that. The value of the investment's tied directly to the value of the real estate. And so with pensions and high net worth investors, I think the question that really exudes in their mind is, how can I make the best return while protecting my downside risk? And what you'll find is that a lot of these private investment categories can have really solid average returns over that time frame without the same level of volatility. So you can be just as competitive, but start to remove some of the instability that comes with those portfolios.
I know there's a lot of confusion, and I know that some of our members have that confusion because they're going to go to the banker and they're going to say, I want to take my money and invest it into real estate. They're like, no need.
Yep.
We got these, publicly traded, REITs, right? And you were talking about kind of the differences between the public REITs and the private REITs. Could you spend more time kind of differentiating those two? Because I think, especially for the audience that's listening, there could be some confusion. Maybe they're gonna hear Equiton and they're gonna resonate with what you're saying. They're gonna go to their regular bank and say, "Hey, I want to participate in Equiton." They're like, "Well, no, we got these are the ones that we have access to."
Yeah.
So, and then if that happens, what should someone do that that is kind of in that situation? How do they find private opportunities like the ones Equiton offers?
Yeah, I think it's a good question. And, look, I'm always the first to admit that when you look at real estate, there's multiple ways of participating in it, right? You can be an active investor in real estate. You can be a passive investor in real estate. If you want to be passive, meaning more hands-off, you can buy public REITs, which are on the stock exchange. You can buy private REITs, which would be more in line with, Equiton. There's always good options in every single one of those categories. I'm never here to sit here and say, private REITs are the end-all, be-all, and that's what everybody should have their money in. That's not true. I still think diversification is a key component to it. And, look, if you're somebody who's got the time to be able to go out and actively manage a physical property and you've got the down payment available to you in cash and you have the income to be able to afford the mortgage, active is a great way to make money in real estate. Where people start to find the niche that they want to look at investments like this is when they do want to be passive. They want to be hands-off. And you're not wrong. Like if you go to a bank and you say, hey, I want to get started in real estate, I'm sure they have some product that will be associated with real estate. But I think it's important to understand that real estate can be invested in passively, both private and public. There's really one difference, and it's not much more complicated than that. I think a lot of the times when you think about private investing, people start to hear the buzzwords. They hear private equity or they hear private investments, and it seems a little bit more elusive than what it really is. There's one big difference, and it's how the investment is valued. That's it. If you buy real estate on the public market, the real estate or your investment value trades on the perception. Do people perceive that real estate company to be good? Well, then the price is going to rise up quite a bit. If something's happening in the marketplace and now they perceive that things are going to be negative, well, then your investment's going to go down. But the question I always have for people is, did anything really change to the underlying real estate? Maybe, maybe not. You could have an extremely well-run real estate company with fantastic financials, growing income, growing profitability, but something happens in the economic world that causes panic and causes a sell-off, which means everything goes down in the public market. But again, did anything change with the underlying real estate? Maybe, maybe not. So when you come to the private side of it, I think that the biggest takeaway I can give people is just that it's the valuation of your investment. On the private side, the value of your investment is tied to the value of the real estate. And so if the real estate has solid financials, good performance, generally speaking, it can hold its value very, very well. It's not to say that it's immune to downsides or negatives. There's still always a potential for those aspects. It's just that the ride, the duration at which you're investing means that you can have a much more consistent and stable return while still getting those competitive targeted returns that you see in the marketplace. So again, I think it's really important for investors to look at that difference between public and private and just understand that one way I think you're getting a more true reflection of the real estate's value and growth versus on the public market, you're dealing a little bit more with perception. How do people perceive that value of real estate? And that's what causes all the fluctuations. The
last time I was, looking into Equiton, and I noticed that everything is in Ontario. Is there a reason for that? Are you guys still doing that, or?
Yeah, so it's a good point. So we operate in many different facets of real estate. When you look at our business, it is mainly comprised of residential properties. We own over $1 billion of residential properties. We have commercial properties. We've got land development opportunities like townhomes and condos. And you're not wrong. I'd say 95% plus of everything that we're doing is Ontario-based right now. Recently, though, we have started to invest into the Alberta market. We like the dynamics there. We think that there's a lot of opportunity for growth. That economy is really seeing a good turnaround. And so we like Alberta. That's something we want to be invested into. And we did that. A couple of years ago, we bought about $50 million worth of properties in Alberta. And I think in the short term, we're going to continue to look to expand our presence in Alberta as well, too.
So is Ontario, Alberta, those are the markets that you guys are going to be focused on? Is there any additional markets or things that you'll look at?
Absolutely. So over the next few years, we definitely want to get more of a national exposure. With a national exposure, there's some key hotspots that we definitely want to take a look at. BC, definitely an example of a place that we want to be included on. Another one would be a place like Quebec. We're definitely looking at opportunities in Quebec as well, too. But look, that's one of the biggest challenges with growing a company and doing it effectively is that you don't want to grow too fast.
Yeah.
That can also create issues.
Yeah.
And so I think when I get asked the question about Ontario, I think there's a great reason for it. When you want to build a business, it's much easier to build it in your own backyard. You get economies of scale. But in a simple way, really mean is that we can buy new properties without having an exceptionally high increase in the expenses. There's little things people don't think about, but when you buy a property and you have a development, for example, and you want to build a condo or a townhouse, well, if you have all the connections local to you, you've got good trades, you've got good GCs, you've got good connections to all the different supplies and materials you got to get. You got good connections with what's happening on a municipal level. What's happening with zoning bylaws. You can become a master of your market. And it's very easy then to accelerate your business in these specific niches. Whereas it might sound nice for a company like ours to go out and be like, okay, well, we have a new development in BC. And then we got a new development in Alberta and a new development in Quebec. That's challenging. Each one is very unique. Each market's totally different. The demographics will change. The zoning bylaws will change. The process for getting things approved will change. And that's why I would say for right now, we've still been heavily concentrated in Ontario is that, look, for a company, we're at...
Well, Ontario will always be Ontario.
And that's the thing. The demand never goes away for Ontario. It's a huge hotspot for jobs. People really want to live here. There's a ton of demand. And that's definitely a reason that we want to be here. But again, it also has to do with growing the business from a prudent standpoint where we can effectively drive revenue growth while not increasing expenses by an exorbitant amount because we're trying new things or trying to find the right partner. So we definitely will continue to expand. But the one thing I will say is when we enter a market, we want to enter it in a big way so we can start to build those relationships and build the economies of scale very quickly. And that's why I say when you look at somewhere like Alberta that we just recently entered with $50 million worth of purchases, definitely something on the radar for us and that we want to continue to expand in that particular marketplace.
It's pretty interesting, let's say 2015, 2016. I would say that when Equiton started, you might have... the cap rates were a little bit higher, right? What's one of the strategies that you guys are applying in order for acquisition, right? Because now it's like $1 billion company. When people start to hear that, they're like, okay, well, maybe there's not a lot of room there to negotiate. So, how is it possible for you guys to continue to grow? Where now it's like, okay, it's like you're like the Coca-Cola, it's like Coca-Cola's not going to get the deal, right? But maybe there's something, you have a specific strategy.
Yeah, I think there's multiple layers to that point. And, for example, it comes down to why can we still continue to grow? I mean, look, there's many reasons. In the space, yes, we're over $1 billion in assets under management, but I'll tell you, as far as real estate is concerned, that's not a lot. There's tons of room left for us to grow in the marketplace. I'd argue that we're one of the fastest growing real estate companies in Canada, and we're doing that for good reason because of our track record and performance.
And I see that.
And the flip side of that as well too is that the growth is just getting started in my mind. I look at the opportunities that are available to us in the marketplace, and I can tell you our goals right now internally are, how do we take the company on to a path where we're getting to $2 billion and $3 billion and $4 billion and $5 billion. And, as a Canadian company operating with Canadian assets, there's still a ton of opportunity just here within our own country to be able to continue to grow the portfolio. And the key to being able to get that growth is that, we can really only go out and buy new development sites or buy new apartment properties by having investors interested in us and wanting to continue to invest with us. And a big part of that is making sure that when somebody becomes a client, we give them the best customer service possible. We keep them up to date with what's happening on the investments, keep you happy with what's happening in your portfolio so that you come back and want to invest into the new items that we're doing. And if not that, you're finding referrals and other people that you want to get involved in this because you feel like you found something that's really working. And so as long as we can continue to generate good performance, communicate effectively to investors, keep them in the loop with what's happening, you'll continue to attract a lot of new business. And that's what we want to be. We want to become, to people, the trusted real estate company in Canada. So when you think real estate investments, you think, well, you got to go talk to Equiton because they do a little bit of everything. And that's really the vision that we're working towards.
What are the buckets right now?
Yeah, so if you were to look at the buckets today, we have 3 different investment solutions. First one's called the apartment fund, essentially just emulating the ownership style of a rental property, but without having to be a landlord. So you can still benefit from monthly cash flow and appreciation whenever the properties go up. But instead of investing in one unit, one property, you're buying into $1 billion portfolio. So you're much more diversified. We then have a secondary option, which is called land development projects. These are very concentrated investments into one particular development site. Could be a condo, could be townhomes. And you're investing into the development process. You're not buying a condo, you're not buying an individual townhouse. You're investing with us in the acquisition of the land, the rezoning of the land, the sale of the individual units, the construction, and the eventual occupancy. And by doing this, you can try to generate larger outsized returns as long as you got the time frame for it. And then we've actually got a third option right down the middle. It's almost like a perfect blend of the other 2 options. It's called an income and development fund. It's a perfect way to get diversification to multiple categories.
Construction, is that kind of like what's under that umbrella?
Yeah, so construction would fall into the land development opportunities where we will build and construct those individual assets, and you will benefit from payouts whenever those projects are completed. But this middle option, income and development fund, is a blend of everything. So half the fund is going to focus on getting you a monthly income stream, and the other half of the fund is going to be diversified in multiple construction development projects. So you get smaller payouts every time one of our projects come to completion. So we have 3 different levels of investing. You know, the targeted return ranges go from 8 to 20%. So regardless if you're somebody looking for cash flow or you're somebody that's looking to park money away from go for larger returns, we have different options. And that's really why we have a robust team to make sure that we can deal with the investors' inquiries, their questions, help them understand what makes sense for them, and at the end of the day, ensure that we're finding investment solutions that are suitable for them based on what your investment goals are. That's really all we're trying to do as a company.
I think this is a great option for a lot of people, especially registered funds where people kind of don't pay too much attention to what's going on with the registered funds. I think it's kind of a place where they just put them to die, and most people don't understand why they put them in there in the first place, and because that's what their accountant said or whatever. Do you have a number of how much registered funds are out there?
You mean just in Canada as a
just
whole?
In Canada, like
it's a great question. I don't have the number on the top of my head.
It must be in the billions.
It's definitely in the billions.
Where people's money is just really underperforming, and the only reason they put them in these registered funds is just protected from tax.
For sure, yeah.
You know, but at the very least, you know, you're saving yourself 50%. But you're also, if your money's not performing over the long run, you might as well pay that 50% because you're the opportunity cost, right?
Yeah, I mean, look, the one thing I always tell people is that I love talking to investors who get the aha moment when you're having a conversation.
Yeah,
a lot of the times people reach out to us wanting to learn more about what we do and just take it as a different real estate investment option. But a lot of the times throughout my years of being in this industry and talking to many different investors, that I find the aha moment comes up for a lot of people when they realize that they can use registered plans to invest in this type of real estate.
Yeah.
A lot of people love real estate. A lot of people want to get involved in real estate. They don't realize that you can use that RSP account that's been sitting in a whatever investment for the last few years and actually get that participating in the growth of apartment buildings or get that invested into the development of a condominium. So many people have pension plans that are sitting around from old employers that they left many years ago and have no idea that they can use their locked-in retirement accounts to actually invest into more real estate. So I can tell you that registered plans has got to be one of the biggest aha moments where people really make the connection and click, because you realize that you don't need to put new cash into the investment, but you can transfer that existing plan that was doing nothing for you into a different investment option that's more focused and concentrated on real estate. So it's a great point you brought up, because that aha moment only comes along every now and then, and it's good when you can find that connection for someone.
Love it. So Austin, look, we're going to wrap things up, but before that, what do you want them to know? How do they engage with Equiton? What do they need to do now?
Yeah, I would say we open ourselves up to every single channel. I guarantee you, if you go out and look up Equiton online, you will start seeing our ads everywhere. And we do that because we want to have good exposure. This is a marketplace that is not well known to a lot of people. But what I really recommend is that you find us on your most preferred platform, because we're there. If you want to check us out on LinkedIn, have a look. If you want to find us on Instagram, Facebook, social medias, we have presences there as well too. Check us out on our website, equiton.com. And the reason that I really suggest these items is because it goes back to the transparency side of things. You know, we talk about $1 billion here, a development project there, a completion over here. That's all just wordplay. At the end of the day, what I want people to see is, what is it that we're actually doing? Where are we buying? Are you from Mississauga? Well, we got properties nearby you. Are you from Guelph? Let me show you what we have in the area. I really want to try and make real estate more tangible and real for people as an investment solution. And knowing that you have a company that's Canadian owned, Canadian operated, and has had a good track record in the Canadian investment space, that's an opportunity that challenge anyone to go out and have a little bit of an opportunity of investigation into, to see whether this is even something that piques your interest. But we're available for you, and we've got all the information there for you to be able to see. So,
love it. Last thing, what inspires you?
I get inspired by opportunity. You know, many, many years ago, I had a good mentor in my life where I really needed the encouragement to take the leap from being in a Big Five bank, safe job, you know what you're doing, go with the flow, but it wasn't inspiring me. I needed something that would challenge me a little bit further. And the best quote I ever got that gave me the inspiration that I look for is that I need to get comfortable being uncomfortable. Because the moment that you wake up every single day and you know what you need to do and you're on that automatic rotation, you're barely ever learning anything new.
That's the moment you start dying.
But I can tell you, coming into Equiton and taking an opportunity with what was at the time a much smaller company, but you can see the vision and you can see the potential, that inspires me. It inspires me to find the growth, to find the opportunities. And I can tell you that watching a company go from $100 million in assets under management to well over $1 billion in assets under management is incredibly inspiring. And it's really important to find those good mentors that'll give you the right verbiage, the right vision, the right goals. And then eventually you get to work with companies like Equiton with great leadership, where you're continuously inspired every single day to, you know, help in making that journey possible. So definitely getting comfortable being uncomfortable and living by a mantra like that will continue to inspire you daily to ensure you're getting out of your comfort zone.
I love it. To be comfortable is like the kiss of death.
Absolutely.
And we'll leave it there. Thank you for coming by. We'll have you again. Stop by again. Alfonso loves you. We'll see you all at the top. Woo! Let's go.